Hi, good afternoon for those in Europe and good morning for those joining us from North America. My name is Marcos Alvarez and I am the Global Head of Insurance for DBRS Morningstar. Today I will be joined by my colleague Javier Ruiz, Vice President, Global Sovereign Ratings. Javier will discuss how catastrophe bonds, or CAT bonds for short, can be used to manage fiscal pressures following natural disasters. However, I will first explain how CAT bonds work and how this market has evolved in the past few years. I would like to remind the audience that you can ask your questions at any time using the appropriate box in Bright Talk. We will answer your questions at the end of the presentation. So let's go into slide one. So what is a catastrophe bond? So cat bonds are one of the most well-known type of insurance-linked securities to transfer catastrophe risk to capital market investors. The first cat bonds were issued in the mid-1990s, and the market has steadily grown since then with a total standing volume of approximately 39 billion at this time. The ILS market, the insurance-linked securities market, represents around 20% of the global reinsurance market capital, which is estimated to be between 500 and 600 billion at this point. So the cat bond is a subsection of the ILS market, and then the ILS market accounts for around 20% of the total capital of the reinsurance industry. So with 39 billion, the catastrophe bond market is still a relatively small size of the entire capital available for the reinsurance industry. The cat bonds has become an important source of capital for the insurance and the reinsurance industry, especially in the last 20 years. There is a growing exposure to cat risk around the world. There are more frequent and more severe cat events globally, and the insurance industry, has been looking for opportunities to bring more capital and more protection so that they can insure those risks. And on the investment side, on the investor side, the cat bonds offer issuers an alternative to traditional reinsurance. And this allows to be transferred to a wider set of investors. But we have to remember that these are institutional investors, what we're talking about. So cat bonds are not typically directed to retail investors. The usual investors on cat bonds includes pensions, endowment funds, specialized ILS funds. Some insurance and reinsurance companies actually invest in cat bonds also to diversify their own exposure to cat risk. But we are talking here about very large investors in general, pension plans as well. So cat bonds are typically structured in a way that payout only occurs once certain loss threshold has been triggered. And these triggers can be in mostly in three different ways. We have indemnity triggers, industry loss triggers, and parametric triggers. Indemnity trigger is the most common trigger. Around 62% of the outstanding cat bonds globally are using indemnity triggers. And these are based on actual losses sustained by the sponsor or the issuer. So it's just like a standard insurance or reinsurance policy where what is paid to the sponsor is the actual loss. The industry loss accounts for 24% of the outstanding cat bonds, and they require aggregate losses experienced by the industry to exceed a predetermined value. The determination that the trigger has been met is usually done by an independent third party. Then finally, we have parametric, which is the least frequent trigger in cat bonds. Around 5% of outstanding cat bonds use the parametric triggers, and they require measurable characteristic of the cover catastrophe, for example, earthquake magnitude or hurricane wind speed, to exceed a predetermined level at a predefined set of locations. Cat bonds typically are rated non-investment grade, given they are high risk, and they also have maturities, typical maturities between 3 and 5 years. One concept that I also would like to discuss is the cat swaps, which is a structure that Javier will mention when he talks about the World Bank facility used to issue cat bonds, because the World Bank usually uses cat swaps in conjunction with cat bonds to offer protection against catastrophe risk for its member countries. So cat swaps are bilateral contracts through which catastrophe losses can be transferred between two counterparties, and they are typically uh, two type of cat swaps. One is the pure cat swap, and the other is the financial cat swap. In a pure cat swap, two counterparties, typically two reinsurers or two insurers, exchange uncorrelated or low correlated catastrophic risk exposures in their businesses in order to improve diversification in their underwriting portfolio and to reduce regulatory capital requirements. So this would be, for example, a Japanese insurer swapping risk exposure to earthquake risk in Japan to an American insurance company transferring its own risk to, let's say, hurricane in Florida, right? Of course, this is this involves extensive modeling so that it's a fair transaction between the two counterparties, but it's a pure exchange of exposure to catastrophe risk. Then there is the financial cat swap, which is a structure where the protection buyer agrees to pay periodic payments similar to premium to protection sellers in exchange of trigger catastrophic losses. So this is the type of cat swap that the World Bank has used in addition to cat bonds that Javier will discuss in the second part of the presentation. Of course, the downside to a cat swap, similar to other derivatives transaction, is that either party to the contract is exposed to counterparty risk. And typically, such transactions will involve highly rated protection sellers so that this risk is mitigated. So how are catastrophe bonds structured? So in this slide, which is a bit convoluted, we have the main features of how a cat bond is structured. So we have the sponsor and the insurance organization, which is the one looking to have this risk transfer out to the capital markets through the way of a cat bond. But almost every cat bond require to set up a special purpose vehicle. We will see that's not exactly the case for the World Bank, but in a typical private cat bond structure, we will see an SPV being set up by the sponsor organization. This SPV will be bankruptcy remote from the insurance or reinsurance company, the sponsor, the issuer. And this is where I mean, the special purpose vehicle is the one that it will actually issue the cat bond to investors. So the investor will send the principal to the SPV, and the SPV will use that to invest through a collateral account or a trust account into very highly rated securities, typically U.S. Treasuries or some multilateral um, bonds. Then if there and the sponsor will pay premiums, periodic premiums to this SPV, which is the extra interest that investor will get on top of whatever yield they get from these low risk investments at the collateral account. So this is the initial setup of the structure. If there is an event that requires a payment, a catastrophic event that requires the payment from the SPV back to the sponsor, um, if it's triggered, and then we will see how that can be triggered. The SPV will send cash proceeds back to the sponsor, and then the investor will lose part of their money or their total investment at that point. But that is only when the trigger has been when the event has triggered the loss, according to the prospectus of the cat bond. And the SPV, the whole purpose of the SPV is also to protect investors from counterparty risk from the sponsor or cedent organization. Again, we will see that that's not exactly the case for the World Bank facility. So in this diagram, we can see what are the two possibilities in a cat bond investment. So the insurance company will issue, well, not exactly the insurance company, but through the SPV, they will issue the cat bond to investors, and then the investors will either have their principal back, their total principal back, or partially, or they might even lose the entire principal. So if no catastrophe occurs, or a catastrophe occurs, but it's less, the total claims, let's say if it's an indemnity trigger, is less than a predefined threshold value, the investor will recoup their principal after maturity, including the high returns that they have earned through the life of the cat bond. In an alternative scenario, there is a catastrophe large enough to trigger the cat bond, then the investors will lose principal partially or completely, and they will only receive the interest until the day of the cat event. Okay. So, of course, for cat bonds to be attractive for investors, they have to offer an interesting yield relative to the market, and that's what we see in this graph. That the coupon, for instance, in 2022, the average coupon in 2022 was in excess of 8%. And then there is the concept of expected loss, which is something that every cat bond has a modeler, a third-party modeler that will provide um, an expected loss, and then we can calculate what is known as the spread, which is the difference between the coupon paid to the investors and the expected loss. And this coupon and this spread, which is almost 6%, was almost 6% for 2022, has actually increased in the first quarter of 2023 for a number of reasons. I mean, recent catastrophe losses in the reinsurance market, also higher interest rates, given the tightening of monetary policies around the world. And then the expectation that the hard market will continue for a few quarters. The hard insurance and reinsurance market will continue for a few more quarters. Then this slide gives us an overview of what kind of peril or risks are covered by the different cat bonds outstanding at this moment. So there is a lot of cat bonds that are covering U.S. risks, and you can see on this pie chart that there is U.S. earthquake, named storm and hurricane, Florida named storm, Texas multi-peril. So at this point, the majority of the cat bond protection in the market is oriented to the U.S. Market in terms of the risk cover. But of course, there are other international or non-U.S. risks like Japan earthquake or European floods that are being covered by cat bonds at this time. And there has been also an interest in using cat bonds to other risks, not only to protect against natural catastrophes like flood or hurricane or earthquake, but also against man-made risk like cyber risk, terrorism, or pandemics. And the World Bank has had an experience issuing a pandemic bond uh, about 5 or 6 years ago that was actually triggered in 2020 with the COVID-19 pandemic. On this slide, we can see how the market has been evolving over the few years. We have to remember that the cat bond market was born in the mid 1990s, following Hurricane Andrew and other big nat cat events that require recapitalization of the reinsurance and insurance industry, particularly in the U.S. And since then, especially after 2006 and 7, the growth of the cat bond market has been uh, quite material. And now we are seeing outstanding for almost 39 billion which of course is a record level. That will be at the end of Q1 of this year. But we have to know that there has been a slowdown in the issuances, the volume of issuances in Q1 of this year versus Q1 of last year, and you can see that in 2021 the amount of cat bonds issued was record at almost 14 billion. That decreased into 2022 to around 10 billion, and now we are expecting that for 2023, full year 2023, there will be total issuances closer to what we saw last year, despite being a decrease in the amounts of cat bonds issued in Q1 of 2023. We'd expect that the market will continue to be attractive to investors, and we have seen renowned interest by both issuers and investors in this market, especially after seeing the record volumes issued by the World Bank with this cat bond covering Chile. So what is our expectations or an outlook for the cat bond market? So we expect a moderate decrease in issuances level during the first half of 2023. We have already seen that Q1 experienced a moderate decrease versus same quarter a year ago, but we think that activity has been picking up and will continue to pick up for the rest of 2023. However, we don't expect that the level of issuances will surpass the record level of 2021. So we probably will see around 10 billion in new issuances in 2023. We have to also take into account that although the market is at almost 39 or 40 billion in total standings, is still a relatively small portion of the total capital available to the reinsurance industry globally, which is, as I said at the beginning of the presentation, 500 to 600 billion, depending on the estimate. We think that the cat bond market will become an increasingly more important part of the reinsurance capital, especially given the catastrophe losses that the industry has experienced in the past few years, that they seems to be everly increasing, and also because of higher interest rates. And now we're seeing a renowned appetite of government-related sponsors like the government of Chile, which would also add a new dynamic to this market. So I think that is all on my end. So I will now pass it to Javier, who will talk more about how cat bonds can be used to manage fiscal pain for governments after natural disasters. Thanks.
Thank you, Marcos, and good morning and good afternoon. So on my side, as Marcos mentioned, I will be speaking on the use of cat bonds from a public sector perspective as a tool to enhance fiscal risk management. So as you can see in the first slide of the sovereign angle, so natural disasters can have a significant impact, not only from a humanitarian point of view, but also from an economic and fiscal point of view. I will be focusing mostly on the fiscal aspects and the potential role of cat bonds to help governments manage these risks. So from a fiscal perspective, natural disasters, can inflict significant pain, and therefore it's important for governments to prepare and plan for these contingent liabilities before they occur. Natural catastrophes can result in significant destruction of physical assets and trigger considerable and sudden fiscal costs for the public sector. Once a disaster strikes, governments may need to rapidly increase spending to rebuild infrastructure or to finance a post-disaster economic recovery. While countries with strong public finances, diversified economies, and liquid debt markets will most likely be able to absorb this shock comfortably, This might not be always the case. In particular, countries with limited fiscal space in face of this extra additional expenditure might need to reallocate the spending and cut on other priorities. For example, low income countries, there could be a risk that the government may need to cut or might resort to cut health and education spending in order to reallocate expenditure to rebuild its infrastructure, which will ultimately be detrimental in terms of their development progress. On top of these extra expenditure pressures, also governments may face underperforming tax revenues, as underlying tax bases might be impaired temporarily or permanently. Um, in the table here that you can see in this slide, we show the results of a study done by the International Monetary Fund, looking at the fiscal cost associated with different series of contingent liability shocks for a sample of 80 countries between 1990 and 2014. According to this study, natural disasters had an average fiscal cost of 1.6% of GDP and a maximum of 6% of GDP. So the impact is, it's significant. Although, as you can also see in this table, the fiscal risks or fiscal impact associated to the financial sector were significantly higher than the natural disaster fiscal costs. Also, I think it's important to emphasize that the risk for natural disasters are not evenly spread across sovereigns. There are specific countries and island economies that are more vulnerable and have more frequent disasters, and therefore, the cost for these economies might be large and constitute a more recurring event. Um, Let me now pass to the second slide, where I'll briefly walk you through, what could be a sound management of these risks. Given the magnitude of the fiscal risk I alluded earlier, identifying and quantifying them, as well as building a strategy to manage this risk, should be an important part of the regular assessment of contingent liabilities and the budgeting process for countries with significant exposures to these events. Once authorities have identified and quantified the fiscal risks, they might decide to implement measures to reduce the contingent liabilities associated to them, such as, for example, limiting building activities, improving physical structure preparedness, or mandating private insurance in high-risk areas. Nevertheless, even after these potential mitigating actions take place, significant fiscal risk will likely remain for the public sector at this point. At this stage, governments may decide to tackle some of these risks ex ante. Policymakers have several tools to pre-finance part of this risk, including purchasing insurance in the form of cat bonds, defining contingency budgets, or setting up natural disaster funds. And any residual fiscal risks after this pre-financing takes place will need to be absorbed by the available fiscal space at the time a catastrophe occurs, which for low and middle income countries might be challenging, but it's fair to say also that financial aid from other countries or international institutions may at least compensate for some of this reduced fiscal space. Then let me pass to the next slide, so where I'll briefly discuss some of the peculiarities of cat bonds. As Marcos previously explained, so cat bonds are typically issued by SPVs and not issued by the cedent or the insurance entity. In simple terms, the SPV will store the cash paid by the investors and disperse the cash to the insured entity if the conditions are triggered. Um, this legal structure has some implications. I think it's worth noting. First, the fact that the cat bonds are issued by an SPV means that this will not increase the government's debt. However, the premiums periodically paid to the SPV will affect the fiscal deficit. Second, the money is ring-fenced in the SPV, which means that if a natural disaster does not occur, the government will not receive any funds or be able to tap or repurpose the funds in the SPV. And lastly, from a credit ratings perspective, the fact that the SPV is isolated from the insurance public sector entity uh, means that the credit quality and credit rating of both uh, could differ. Um, Let me pass to the next slide where I'll briefly discuss on recent trends on the public sector cat bonds market, which has been increasing over time. Especially there are a few years that you can see in the chart on the left where there has been significant issues in 2017, 2019, 2018 and 2020. But still, the size of the market remains relatively small, especially if we compare it with the overall, pool of sovereign bonds. Um, it's also worth noting that in both of these charts, we are including not only cat bonds where the issuer entity is the sovereign, but also the ones where multilateral institutions are the beneficiaries, and the ones where government-related entities or institutions fulfilling a public sector role mandate, such as the California Earthquake Authority or the Turkish Catastrophe Insurance Pool. The companies in this latter group, the government-related entities or institutions fulfilling a public sector mandate, usually are not part of the government perimeter. However, they generally fulfill a public sector role and in general have been created by law. Using Artemis deal directory to create these charts, we can see that in terms of cedents, government-related entities or entities, fulfilling a public sector mandate, have been the largest players in the public sector cat bond market, accounting for cumulative 7.4 billion US dollars, followed by sovereign states, central governments that accumulated issuances during this same period, 2001 2023, of 3.4 billion US dollars. From a geographical perspective, the chart on the right, it's clear that the US is the largest player in the public sector cat bond market, mostly driven by the GRE public sector mandate entities, with a cumulative 6.3 billion US dollars of accumulated issuances. So let me now comment after showing these trends in the previous slides that, as I mentioned before, the public sector cat bond market remains small. The literature available on cat bonds, including the ones produced by the IMF, identify that high transaction costs, complicated underlying catastrophe models, and narrow investor base are some of the key obstacles preventing cat bond market from scaling up further. On this front, the World Bank has played a key role in easing some of the challenges for emerging markets and low and middle income countries. Through its capital at risk notes, the World Bank has played a key role in mediating the transfer of risk from the sovereign clients to the capital markets. One of the key attributes is basically that the World Bank's intermediation simplifies the procurement process as it eliminates the need to establish an offshore SPV. Um, Instead, the World Bank issues a bond supported by their own balance sheet and hedge it with a swap or a similar contract with the government or client. This both simplifies the procurement process, but also avoids potential legal regulatory restrictions um, that could prevent governments from setting up an offshore SPV. Since 2016, the World Bank has intermediated all cat bonds in this data set compiled by Artemis that we are using for this presentation. As Marcos mentioned, I think one interesting case is the latest transaction done by the World Bank in conjunction with the Republic of Chile to provide insurance against earthquakes. This is, this transaction which finished in March this year was the largest single country cat bond and swap transaction executed by the World Bank to provide 630 million US dollars in insurance protection against earthquakes in Chile, with 350 million of cat bonds and 200 million of cat swaps. This dual transaction combining cat bonds and cat swaps permitted the World Bank to tap both bond investors and insurance and reinsurance companies, and basically maximize the risk bearing capacity that the World Bank could access for this type of transaction. The You can see the details on the right. So this agreement provides coverage for 3 years, with payouts triggered if an earthquake meets predefined parametric thresholds based on magnitude and location. Um, the contract is aimed to protect Chile from very low probability earthquake events, which on average occur approximately every 70 years, in exchange for an annual risk premium of 475 basis points. Importantly, I think to notice that this transaction is part of a comprehensive catastrophic risk management strategy by Chile. This strategy is meant to deal with three types of natural events. First, the ones with greater frequency but with lower fiscal cost, that should be absorbed within the budget through the resources of the state treasury. Secondly, less frequent events but with a somewhat greater impact would be covered through a fund for natural disasters that is currently under discussion. And lastly, for events of greater magnitude but of very low probability of occurrence, like the ones I was mentioning earlier, this is where this cat bond, cat swap enters into play to ensure against this low probability, very low probability, but with a greater potential fiscal cost. And let me conclude, at least on the overall remarks, that in general, the size of the cat bonds, as I was mentioning, from a public sector perspective, remains small. However, we see further scope for the cat bond, public sector cat bonds to increase its usage over time. In our view, low and middle income countries, especially those exposed to natural disasters, could benefit the most from buying insurance in the form of cat bonds for the following three reasons. First, these countries usually have weaker credit fundamentals than advanced economies and therefore face higher pressure from capital markets after a natural disaster occurs. Secondly, these countries usually have high current investment needs that could lead to to boost, potential output in these economies. Therefore, using cat bonds, while there could be, at the expense of paying a potentially expensive premium, could free up resources that would otherwise would have been left unused in a reserve fund with a high opportunity cost. And lastly, several countries in this group, low and middle income countries, face high disaster risks, especially or for example, small countries, islands in the Caribbean. So with that note, let me conclude the initial remarks and pass it back to Marcos to see if there's any questions.
Thanks, Javier. So I remind the audience that you can type in your questions in the box of the Bright Talk app, and we will um, answer them now. So in the meantime, we have one question, Javier. Is there recent evidence of these public sector cat bonds being triggered? An example of payouts made by the World Bank in recent years, for example?
Yes, thank you, Marcos. Thank you for that question. Yes, actually, there has been payouts. Let me briefly comment on two examples. One, a partial trigger, which is the case of Peru, and a full trigger, which is the case of Mexico. Both of these cat bonds were parametric bonds, which basically, as Marcos said, given that there are very specific thresholds, usually lead to faster payouts, usually between 1-2 months potentially. So in the case of Peru, in 2019 there was an earthquake of 8.0 magnitude that struck the country and triggered a 30% payout of the face value of the Peru tranche of a multi-country cat bond for the Pacific Alliance issued by the World Bank. Uh, this particular tranche covered for a maximum 200 million US dollars for Peru, and after this was triggered, the payout was 30%, which is the equivalent of 60 million US dollars shortly paid to Peru. That helped the country to finance its reconstruction efforts. In the case of Mexico, the case I was mentioning, in 2017, also there was an earthquake of magnitude 8.1. And that triggered a full payout of the cat bond issued by the World Bank with the ultimate sponsor, the FODEN, so the Natural Disaster Fund in Mexico, and triggering 150 payout for the country shortly after the catastrophe occurred. So I think these are two good examples of these cat bonds actually triggering some payouts, and this helping these countries, particularly in Latin America, to finance their efforts to rebuild their infrastructure.
Yes, Javier, and I would also add the pandemic bond, also issued by the World Bank, I think 6-7 years ago. It was hit by the COVID-19 pandemic in 2020, and investors suffer partial losses on that bond. I think there were two series. One was completely wiped out, and the other was partially impacted, partially affected. So yeah, that's another recent example of a cat bond being triggered. And of course, those are public sector bonds that we were discussing, but um, um, the last large hurricane in Florida, Ian's hurricane, also triggered losses on some cat bonds. Um, think in the range of $2 to $3 billion in losses to cat bonds at that time. And then we also received a question about if Morningstar currently rates any cat bonds. So not at this moment. We are not rating cat bonds, but is of course something we have considered. And I don't have any more questions from the public, so I would like to thank Javier and the audience for your time today, and want to invite you for our future webinar. So keep tuned in our website for future insurance and sovereign webinars. Thanks.
Thank you very much.
Bye.
Bye-bye.